We are now going to work through an example to make sure that you are happy with everything that we covered in this lecture. So in this example, we are given actual information for the 20X3 financial year. We have the opening inventory for variable costing and also the opening inventory for absorption costing. For both, you can see we have 4,000 units sitting in opening inventory. However, you can also see that the rand values of opening inventory are different for variable costing and absorption costing. So what is the reason for that? We know with variable costing, we only include variable production costs in the cost of our inventory. On the other hand, with absorption costing, we include both variable production costs and also fixed production costs in the cost of our inventory. So it should therefore make sense that the value of opening inventory for absorption costing is higher than the value for variable costing because it includes both your variable and your fixed production costs. We've then been told the number of units that they manufactured during the year. We have their sales, the rand value, and also the number of units. We've got the material cost per unit, the other variable production costs, sales commission, fixed production costs, and fixed selling and admin costs. Now let's just mark these off. We know that our material cost is a product cost. We are allowed to include the cost of material in the cost of our inventory. Your variable production costs are also manufacturing or production related costs. So this is also going to be a product cost. Sales commission is a period cost. It's not included in the value of inventory. Your fixed production costs are obviously manufacturing in nature because they relate to production. So this is also a product cost. And lastly, the fixed selling and admin costs will obviously be a period cost. That has nothing to do with production or manufacturing, so it can't be included in the value of inventory. Then please note, this fixed production cost over here, even though it's a production cost and it's manufacturing in nature, if we are using variable costing, we know that we can only include variable production costs in the cost of inventory. So if variable costing is used, this fixed production cost will not be included in the cost of inventory. It will be expensed in the period incurred. So even though it's a manufacturing related cost, it will not be included in the cost of inventory. So let's just make a note of this. If we are using variable costing, this cost over here will have to be expensed in the period incurred. It will not be included in inventory valuation. However, if we are preparing a statement using absorption costing, then we include both of our variable and our fixed production costs in the cost of inventory. So if we are using absorption costing, then this cost will be included in the cost of inventory. We are then given budgeted information for the 20X3 financial year. We have their normal capacity to be 30,000 units, and we have fixed production costs of 156,000 Rand. Inventory is valued according to the first in, first out method. In part A of the required, we need to prepare the actual statement of comprehensive income for the 20X3 financial year, first using variable costing and then using absorption costing. All right, so let's start with our variable costing statement. All right, so this is my actual statement of comprehensive income using variable costing. Go back to the information provided in the question. We always start with sales. No calculation necessary over here. We were given sales of 800,000 Rand, so that's the starting point in your calculation. We then deduct cost of sales. And please note, because we are using variable costing, we only deduct variable production costs, because only variable production costs are going to be included in the cost of inventory. So what are my variable production costs in this question? We have material at a cost of R5 per unit, and we have other variable production costs at a cost of R6 per unit. We need to multiply that by 32,000 units in order to get the total cost. So that's my material cost and my other variable production costs. Please note, this is variable costing, so your fixed production cost over here of 150,000 Rand is not included in the value of inventory, and instead it is just expensed in the period incurred. So you'll see right at the bottom, below contribution, we have our fixed production costs of 150,000 Rand. So not included under cost of sales because this is variable costing. Instead, this cost is expensed in the period incurred. Then please remember, in order to calculate the value of cost of sales, we take our opening inventory, we add our current production costs, we deduct closing inventory, and that will give us cost of sales. So let's look at our calculations for opening and closing inventory so that we can calculate cost of sales. If you go back to the information provided in the question, you are not required to perform any calculation for opening inventory. Opening inventory has been given for variable costing purposes. We have a value of 44,000 Rand. So you can just include that over there in your calculation. However, we are going to have to calculate the value of closing inventory. And again, please note in the question we were told that the company values their inventory using the first in, first out method. So we have already looked at this. The formula that I provided you with in order to value inventory using the FIFO method is we take our current production costs and we divide by our current production in units. So your current production costs come directly off the face of your statement of comprehensive income. There's my current production costs for material and for other variable production costs. Please note once again we are using variable costing, so fixed costs are not included in the cost of inventory. They are expensed in the period incurred. So let the format of the statement guide you. Those are my current production costs, and those are the only costs that I will use in order to value my closing inventory. So that comes directly off the face of your statement. Your current production in units, we know that the company manufactured 32,000 units this year. So divide by 32,000 units to get your inventory cost per unit. How many units will they have in closing inventory at the end of the period? In opening inventory, they had 4,000 units. They manufactured another 32,000 units, and they sold 34,000 units. So that's a very simple calculation. There will be 2,000 units in closing inventory at the end of the year. So that means closing inventory is going to be valued at 11 Rand per unit multiplied by 2,000 units, giving me a value of 22,000 Rand. So that's how we calculate the value of cost of sales. Then I want you to pay attention to the format of this statement. We start with sales. We take out cost of sales. And because this is variable costing, we then deduct any other variable costs so that we can calculate our contribution. So what other variable costs were we given in this question? Sales commission is going to be a variable cost because it varies with the number of units sold. So that is a variable cost. It's R1.20 per unit, and please note you don't multiply by the number of units manufactured, you multiply by the number of units sold. This is a selling cost. The cost will vary with the number of units sold, not with the number of units manufactured. So that's how we perform the sales commission calculation over there. So sales less all of your variable costs is going to leave you with contribution. Please make sure you use the correct terminology. Then after we have contribution, we deduct all of our fixed costs. We have already deducted the fixed production cost, but we also had fixed selling and admin costs in this question. So deduct your fixed selling and admin costs, and you can then calculate your net income. So that deals with the first part of the required. We've prepared the actual statement of comprehensive income using variable costing. We are now going to prepare the actual statement of comprehensive income using absorption costing. Now, please remember the only difference between these two approaches is with absorption costing, we won't only include variable production costs in the cost of inventory, but we will also include our fixed production costs in the cost of inventory. Now, I want you to go back in your notes to where I gave you those extracts from IAS 2. I told you that with IAS 2, remember, with IAS 2, we are working with absorption costing, meaning that we include both our variable and our fixed production costs in the cost of inventory. And we are told that the allocation of fixed production overheads must be based on normal capacity. And then they even explain what normal capacity is. Normal capacity is the production expected to be achieved on average over a number of periods or seasons under normal circumstances, taking into account any loss of capacity resulting from planned maintenance. And then you are also told that the actual level of production may be used if it approximates normal capacity. And then I just want you to add over here, if you are not given normal capacity in questions, you should please use the budgeted capacity. So in terms of IAS 2, we should allocate fixed production overheads to the cost of inventory based on normal capacity. And then they even discuss what normal capacity is. It's the production that is expected to be achieved over a number of periods or seasons under normal circumstances. So it's not just your expected production for 1 year, but it's over a number of periods or seasons. So for example, we look at our production that's expected under normal circumstances over the next 5 years. And we also take into account planned maintenance. So obviously, if our machines have to be maintained, that will result in some downtime where we won't be able to produce any units. That must be taken into account because that is a part of the normal operating activities of the company. They have to maintain their machinery. So we look at what our planned production is over the next 5 years, for example. We look long term, not just over 1 year. We look over a number of periods or seasons. We take into account any planned maintenance, and that will give us our normal capacity. So when we allocate our fixed production overheads to the cost of inventory, that must be based on normal capacity. Then in terms of IAS 2, they tell us if your actual level of production approximates normal capacity, then you can use the actual level of production. So in other words, if your actual is very close to normal capacity, then you can use the actual. And then I also told you, if you are not given normal capacity in a question, you can then use the budgeted information. So let's look at how we need to perform this calculation in our example. We were given normal capacity in this question. Normal capacity is 30,000 units. And we have our budgeted fixed production costs of 156,000 Rand. Now what you are going to do, I want you to jump forward in the suggested solution to our calculations. We know that in terms of IAS 2, fixed production overheads must be allocated to production based on normal capacity. So what the company is going to do at the beginning of each year, they are going to calculate an allocation rate. And you calculate the allocation rate by taking your budgeted overhead for the year and dividing by normal capacity. Let's discuss this in a bit more detail. First, why are we using our budgeted overhead? Please note I told you that this calculation is performed at the beginning of the year. At the beginning of the year, you won't know what your actual overhead cost is yet. You only know your actual overhead cost at the end of the year. So if we are performing this calculation at the beginning of the year, you need to use the budgeted overhead in your calculation. Also, please note, this calculation must be performed at the beginning of the year because we can't only value our inventory at the end of the year. That's too late. We need to be able to value our inventory already at the beginning of the year. We need to be able to determine the value of our inventory so that we can add a markup to get our selling price. You can't only perform that calculation at the end of the year because then it's too late. So you are forced to use your budgeted overhead in this calculation. Then, why are we dividing by normal capacity? Because IAS 2 specifically tells us that our fixed production overheads must be allocated based on normal capacity. All right, so please make sure that you understand what you are doing in this calculation. In step 1, we are going to calculate an allocation rate at the beginning of the year. You calculate the allocation rate by taking your budgeted overhead for the year and dividing by normal capacity. So we have an allocation rate over here of R5.20 per unit. All right, so I've already discussed this question with you. Why do we use budgeted data? Because we need to know the cost of our inventory at the beginning of the year, because we use the cost as a basis for determining our selling price. We can't wait until the end of the year to perform that calculation. And at the beginning of the year, we don't have the actual fixed overhead. We only have the budgeted cost. So we are forced to use budgeted information in that calculation. Now, can't this timing problem be overcome by calculating your rates on a more frequent basis? In other words, calculating them monthly. So what this question is asking is, why don't we wait until the end of January? At the end of January, we will know what our actual cost is for January, and we can use that to determine our rate for February. At the end of February, we will know the actual cost for January and February, and we can then use that in order to determine the rate for March. So why don't we do this? Instead of just performing one calculation at the beginning of the year where we calculate one rate for the entire year based on budgeted information, why don't we perform the calculation more frequently using up-to-date actual information? And the reason for this is because activity levels of the company will vary from month to month, especially if we are dealing with a company where they have seasonal fluctuations in their sales. So if the activity levels vary from month to month, that is going to cause large fluctuations in the activity rates. So instead of having a standard activity rate of R5.20 per unit, which we will use for the whole year, if we perform this calculation more frequently, that allocation rate is going to vary on a month-to-month basis. And the problem with that is we know in terms of IAS 2, normal capacity is the capacity that is expected to be achieved on average over a number of periods or seasons under normal circumstances. So if this rate is fluctuating every month, then this does not represent typical normal production conditions. So please note, we don't perform this calculation every single month based on actual information. Instead, what we do is we perform this calculation once off at the beginning of each year, and because of that, it is based on budgeted information. And we have one rate that we use for the entire year. So how this is going to work is every time the company produces 1 unit, we are going to allocate R5.20 in order to cover our fixed production overheads. And if we do that, we are complying with IAS 2 because we are allocating this cost based on normal capacity. All right, so every time a unit is produced, they will allocate R5.20 in order to cover our fixed production overheads. Then please note, before we move on to step 2, this allocation rate that you calculate in step 1 must always be a rate per unit. So if you calculate a rate per hour, that must first be converted into a rate per unit before you move on to step 2 of your calculation. So let me give you a quick example over here. Let's say, for example, I tell you that our budgeted overhead for the year is 100,000 Rand, and I give you normal capacity to be 20,000 hours. So if you take your budgeted overhead of 100,000 Rand and you divide by normal capacity of 20,000 hours, that is going to give you an allocation rate of 5 Rand per hour. However, I've told you that this allocation rate must be a rate per unit. It must not be a rate per hour. So you are then going to have to determine how many hours it takes to make 1 unit. So for this example, I want you to assume that it takes 0.5 hours to make 1 unit. So we are then going to multiply this by 0.5 hours for 1 unit in order to get our allocation rate per unit. So we'll then have an allocation rate of 2.50 Rand per unit. All right, so if you do calculate an allocation rate per hour, it must be converted into a rate per unit. In step 1, your answer must be a rate per unit. Then in step 2, after you've calculated your allocation rate per unit, you are now going to calculate your absorbed overhead. And you calculate the absorbed overhead by taking the allocation rate from step 1 and multiplying by actual production. And please note, in this question, they actually produced 32,000 units this year. So that gives us an absorbed overhead of 166,400. And please note, it is the absorbed overhead that is taken to cost of sales and that gets used in inventory valuation. So we don't use the actual fixed overhead in our calculation, we use the absorbed overhead. So what I recommend you guys do, and we need to do this to make sure that we comply with IAS 2. If you are required to prepare the absorption costing statements, I recommend that you always perform these calculations up front first. In step 1, you are going to calculate an allocation rate at the beginning of the year. We are then going to use this rate in order to value our inventory throughout the year. So every time the company produces a unit, they are going to allocate 5.20 Rand to cover their fixed production overheads. So that's why in step 2, we take the rate and we multiply it by actual production. Because I said to you, every time they produce a unit, they will allocate 5.20 Rand in order to cover the costs of fixed production overheads. So at the end of the year, they would have allocated 166,400 to the cost of inventory. Then in step 3 and 4, we need to calculate our variances. And this happens at the end of the year. Please note that step 2 will happen throughout the year. So every time the company produces 1 unit throughout the year, they will allocate 5.20 Rand in order to cover their fixed production overhead costs. But now when we get to the end of the year, we will know what our actual fixed overhead cost for the year is. And remember, the problem is, because we had to perform this calculation at the beginning of the year, this calculation was based on budgeted information. So at the end of the year, we now have the actual information, and we now need to take this into account because there's definitely going to be a difference between your budgeted cost at the beginning of the year and your actual cost at the end of the year. So at the end of the year, when we now have the actual information, we will then calculate these variances. So in step 3, you are first going to calculate your expenditure variance, and in step 4, you are going to calculate a volume variance. Now, your expenditure variance is just the difference between the actual overhead and the budgeted overhead. So if you go back to the information provided in the question, here's my actual fixed production cost. It's 150,000 Rand, and my budgeted cost was 156,000 Rand. So that is going to give me a variance of 6,000 Rand. And please note, you must state whether the variance is favorable or unfavorable. In this example, we have a favorable expenditure variance because your actual overhead cost is less than the budgeted cost. We then need to calculate the volume variance. And the volume variance is the difference between your budgeted overhead from above and the absorbed overhead that you calculated in step 2. So there's my absorbed overhead in step 2. And that gives me a variance of 10,400 Rand. Now please note that this is a volume variance. So if you are trying to determine whether the variance is favorable or unfavorable, you shouldn't look at Rand values. Instead, you need to look at your production volumes. So another way to look at this calculation that actually makes more sense, and it gives you exactly the same answer, is to take the difference between what you actually produced and what you budgeted to produce. So if you go back to the information provided in the question, this company's normal capacity is 30,000 units. So they would have budgeted to produce 30,000 units. They actually ended up producing 32,000 units. So they produced more than what they budgeted to produce, or more than their normal capacity. You then multiply that by your allocation rate from step 1, so the 5.20 Rand from step 1, and that is going to give you exactly the same answer. However, the interpretation over here is a little bit easier because you now have the volume. So you can see that the company actually produced more than what they budgeted to produce, or their actual sales were more than their normal capacity, meaning that this variance is also going to be favorable. And then please note the sum of your expenditure variance and your volume variance will give you your over or under recovery. But please don't perform the calculation in that way. You must show these variances over here separately on your statement of comprehensive income. All right, so if you have to prepare the absorption costing statement, before you prepare the statement, please work through these 4 steps over here to make sure that you are allocating your fixed costs based on normal capacity. So at the bottom of this page, you will see, what if labor is a fixed cost? If labor is a fixed cost, we know that labor is a product cost, it's not a period cost, so we are allowed to include the cost of labor in our cost of inventory. So if labor is a fixed cost, it also needs to be allocated to production based on normal capacity, meaning that we would need to perform exactly the same calculation as we did above for your overhead. So please understand, you are not performing this calculation like this because it is an overhead. You are performing this calculation like this because it is a fixed cost. And you should perform this calculation for all of your fixed costs that are manufacturing in nature. So if labor is also a fixed cost, you should perform the calculations above. So in step 1, you would calculate an allocation rate for labor. In step 2, you would calculate the absorbed cost. In step 3, your expenditure variance. And in step 4, your volume variance. So you perform this calculation for all of your manufacturing related costs that are fixed costs. All fixed costs must be allocated based on normal capacity. All right, and then after you've performed these calculations, we can now complete our actual statement of comprehensive income using absorption costing. Please note, most of the calculations are going to be exactly the same as our variable costing statement. You can see your sales amount is exactly the same. Then when we calculate cost of sales, please note that the only difference is, instead of only including our variable production costs under cost of sales, we are also including our fixed production costs, because we are now looking at absorption costing. So your material and your variable production costs are exactly the same as what we looked at under variable costing. For your fixed production costs, please note, this is not the actual cost that you include under cost of sales. It is the absorbed cost that we calculated in step 2. So that's extremely important. If you've already performed all of these calculations in step 1, 2, 3, and 4, you'll see it's then very easy to actually prepare your statement. But if you try and prepare the statement without first performing all of those calculations, then you're going to struggle. So first perform those calculations, then prepare your statement. It's the absorbed fixed production cost that comes in under cost of sales. Then, for opening inventory, you were given the value of opening inventory in the question. Please make sure that you use the value of opening inventory for absorption costing now. And in order to calculate the value of closing inventory, we need to look at a separate calculation over here. But remember, we are looking at the first in, first out method. So we are going to look at our current production costs. So let the format of the statement guide you. These are your current production costs. So please see above, when we were using variable costing, my current production costs only included my variable production costs. However, we are now using absorption costing, so we also include that absorbed fixed cost in our calculation. But apart from that, the calculation is exactly the same. Take your current production costs, so your material, your variable production overheads, and your fixed production overheads. You divide by your current production in units. Remember, that's the formula that we use for the first in, first out method. So that gives me an inventory value of 16.20 Rand per unit. We already calculated previously that there are 2,000 units sitting in closing inventory. So you can then calculate the value of your closing inventory. Then, again, you need to pay attention to the layout of this statement. Sales less cost of sales is going to give me gross profit. However, before I can calculate gross profit, I need to take into account my expenditure and volume variances that are calculated in step 3 and step 4. Because the problem that we have right now is we are not expensing the actual fixed cost for the year. What is the actual fixed cost? We have an actual fixed production cost of 150,000 Rand for the year. But we are not expensing 150,000 Rand. We are currently expensing 166,400. So we need to take these variances into account. And after we've done that, you will see the net effect is we are going to end up expensing our actual fixed overhead cost of 150,000 Rand. What are the variances that are calculated? We have a favorable expenditure variance of 6,000 Rand and a favorable volume variance of 10,400. Now please note, if these are favorable variances, they are going to be treated as income in your statement of comprehensive income. Makes sense, they're favorable, so they're income. So this is income, and this is also income. Please note, if the variances are unfavorable, you then treat them as an expense on your statement of comprehensive income. Now look at the net effect. If we have an expense of 166,400, we have income of 6,000 and income of 10,400, the net effect is we are expensing the actual fixed overhead cost of 150,000 Rand. However, please note, you don't just expense the actual cost under cost of sales. In cost of sales, you include your absorbed cost. You use that to calculate your value of closing inventory. And after you've calculated cost of sales, so first you calculate your cost of sales. After calculating cost of sales, you take these variances into account, and then you will see the net effect is you expense the actual cost for the year, and that will give you your gross profit. So note the terminology. We can't call this contribution. With variable costing, we first deducted all of our variable costs. So sales less all of your variable costs gives you contribution. Here we can't call this contribution because we are also taking out fixed costs under cost of sales. So sales less cost of sales gives me gross profit. Then we can take into account all of our other costs that are not manufacturing in nature. So all of our period costs. Remember, we had sales commission in this question of R1.20 per unit. Please remember to multiply by the number of units sold and not the number of units produced. And we have fixed selling and admin costs of R140,000. So you can then complete your absorption costing statement.